For more on today's monetary policy decisions, let's hear from David Owen, Chief European Financial Economist at Jefferies International. Good to see you, David. Can I ask you about what you think the threat of inflation is in Europe? Isn't it true that actually core producer prices, they're slowing down?
Yeah, well, I think there's actually no major inflation problem whatsoever in the Eurozone. If we look at all the indicators that one would typically look at, for example, unit labour cost growth, that's actually negative at the moment in the Eurozone. Productivity growth has been outpacing wage inflation. Moreover, there is no monetary growth. The money supply growth is virtually non-existent.
So, why are we going to get what everybody's expecting to get? This another quarter point?
I have absolutely no idea. I mean, the policy move in April was a policy mistake. The move, if they go today, again, will be a further policy mistake. In fact, it makes matters a lot worse to the periphery. Not just Greece, Portugal, and of course Ireland, but also Italy, which struggles with the level of the euro.
You've got to wonder if Trichet is playing a political game here, because he obviously wants to throw the ball back into the court of the governments and tell them to solve their debt crisis, because so far it's been the ECB that's been keeping European banks alive.
Yep.
But then also, he retires in October, so this is his legacy here.
Well, his legacy isn't, I hope, to blow up the Eurozone, but obviously if he carries on raising interest rates, he puts more and more tension on the system and makes it more likely that they'll have to continue supporting problematic banks in the periphery by pumping in liquidity. So, at the end of the day, he is making matters, I think, a lot worse.
Now, when we're looking at interest rates and a central bank putting up interest rates, back in the good old days, before all this crisis, this would have been quite a big deal. With borrowing costs going here, there and everywhere at the moment, does it really matter that much anymore?
Well, it does matter to the core. If you actually look at what's happened to interest rates, for example, in Germany, the actual rates that people pay, they've hardly moved at all. But if you look at Portugal, since the beginning of this year, rates have gone up fairly substantially. So if you're in Portugal, you can see the effects of borrowing costs going up quite dramatically.
What's your opinion on the talks currently that are going on between the banks, the private creditors and governments? Where do you think this thing is going to go? Do you think that some sort of default or restructuring of Greek debt, of perhaps Irish, of Portuguese debt is what we need?
No. I think eventually we will have to see a default, and I think the market's coming around to the view it may not simply be Greece, it may also be Portugal. Moody's downgrade yesterday, I think, heightened those risks, and also Ireland may follow. So the market is coming round to the view that there may be more defaults than simply Greece.
When I say it's what we need, do we need to get this thing finished with, or is it best that we keep kicking the can down the road?
Well, the issue is if they allow Greece, for example, to default at this point, the banking sector in Greece will see a major outflow of deposits, and the banking sector in Greece could effectively not function. And that would mean, at the end of the day, the ECB would have to continue pumping in even more liquidity. The banking sector's balance sheet in Greece is high; it's way above the sovereign. So this is the issue. It's cheaper and probably easier just to continue kicking this can down the road. But they're going to have to finance Greece, Portugal, and Ireland for several more years probably to come.
And what about the credit ratings agencies? You mentioned Moody's, and it does seem to be that the politicians and others are starting to gun for those credit ratings agencies and saying, look, stop dictating our policy here. What do you reckon?
Well, the timing of the downgrade yesterday by Moody's was obviously very unwelcome, and it led to this monumental move in the markets. But at the end of the day, the rating agencies are supposed to be independent, and they did actually put Portugal on negative watch. It wasn't the case that it was a huge surprise, but the timing is obviously very unwelcome.
Let's move on to the Bank of England, if we could. It's going to keep rates on hold today. Now, you say there's not much of a problem with inflation in Europe. Here, it's double the target. It's 4.5%.
It is, but again, the UK is still living the effects of the banking crisis, which only really got going in 2007, and then with Lehman's going down in 2008, suddenly got much worse. GDP in the UK, as you mentioned before, really has been flatlining. It hasn't really grown at all over the last few months. And moreover, if you strip away VAT, strip away energy prices and the effects of the exchange rate, there is not a major inflation problem again in the UK. And moreover, wage inflation basically hasn't really accelerated particularly at all.
So we haven't seen those secondary effects?
Not yet, no. So I think the MPC is right to keep rates on hold at 0.5.
So your predictions for the next 12 months, if I can put it that far ahead, goodness knows what we'll be talking about in 12 months, where we'll be, but for the ECB and the Bank of England?
Well, I think rates will go up probably today, I'm afraid, from the ECB's, and that will be it. So rates will be at 1.5. And
for the next year or so?
For the next year or so. I think once we get the next rate rise and we see further stresses rises, that will be it. And for the UK, I think rates will eventually go up on a one-year view, and there may be 1% in 12 months' time, but I think the first rate rise will be delayed.
Okay, all right, David Owen, Chief European Financial Economist at Jefferies. Thanks for being with us. Okay.